Well, welcome back to Finance Uncut. On today's episode, my 2022 predictions. And coming in from Forbes, inflation hits 15%, fossil fuels boom, and a hypersonic Cold War starts. Here are the predictions for 2022. Now, before we get to the rest of the article, let me share my first prediction for 2022. So my first prediction is we're going to continue seeing food prices rise. Now, we've got issues with fertilizers and energy, and that is going to cause food shortages and rises in food prices. And I've been investing in agriculture throughout this year. We'll touch on that later. And I'll continue to do so into 2022 and beyond. Now, before we get back to that article, let's just cut to a clip with Chris Macintosh.
Chris, why do you think the probability is high that we'll run into food shortages? And how do you invest around that? How are you doing that personally for your hedge fund?
Yeah, so there's two elements to this, right? One, I'll answer the last bit and then we'll go back to why I think there's going to be food shortages. You can profit from these things, right? And that's great. That's what my job has been, right? So for us, it's been fertilizer companies. They have the highest sort of profit margins within that space. They're far less easily coerced. So for example, if you've got a large farming chain, right? As we've seen, if you're non-essential, you're non-essential. And you might think, well, food's never going to be non-essential. Ha! Guess what happened in 2020, right? When they said that only supermarkets can remain open. And in the United States, it's roughly 30 to 35%, I think it is, of food that is consumed is not consumed via supermarkets. It's delis and hotels and restaurants and things of that nature. So you take 30, 40% of your food supply, that was deemed non-essential. And you might say, oh, well, it's a bunch of delis and stuff, and maybe 10% of them went away and didn't make it through, whatever. No, it goes deeper than that, because they were purchasing from farmers who did not have contracts with the supermarket chains, okay? And those guys
they're bust.
They're bust. A lot of them are bust, and they were plowing their food back into the ground because they were non-essential. So think about the capex spending that they've just done in 2020 and 2021. I'll tell you what it looks like. Right. That's what it looks like. Right. Because A, they didn't make a profit in 2020, and B, when they look forward, they go, what does the future look like? We don't know. There is so much uncertainty that their ability to go out and spend on increasing acreage or anything like that has been massively curtailed. And so
now it's even more centralized than it was before.
It's even more centralized than it ever was before, 100%. Right. And so, you know, because and when it comes back to the inflation-deflation debate, which I think is the wrong way to think about it, because what we're seeing across the board is an extraordinary amount of destruction of supply, which then on top of it, we've had extraordinary fiscal and monetary expansion. The combination of all of that leads you into a stagflationary environment, right? You and I might have made more money this last year than any year before, just say, for example. I don't think we did, but never mind. Our lifestyle is still worse. My lifestyle's worse. I know your lifestyle's worse.
Yeah.
Right?
Yeah.
And so that's stagflation, literally. And we're the lucky ones. Right? You've got people who've lost their businesses and lost their jobs and everything else. So anyway, so this is happening on a global scale. So the food shortages are definitely coming. And then the other component behind it, of course, is energy, which comes into this ESG, woke, carbon neutral narrative. And so the costs in terms of energy have all been rising. You know, we just think about this. Going into the lockdowns, pre-lockdowns, the price of energy now is far higher than it was pre-lockdown.
Right.
but we just stopped the planet. We stopped as many planes flying around. We stopped cars driving around. So is that not destruction of demand? Yes, it is. So then you go, how is it possible that we have prices going up? Because while you're destroying demand by stopping productivity. And by stopping productivity, you're stopping supply.
Even faster.
So we've just been decimating supply. And the inflation that we've had to this point now is nothing like what's coming. There's a catch-up coming. So we're going to have inflation and we're going to have shortages in the foodstuffs. And I think what is likely to happen is we're going to have rationing. We're going to have emergency powers enacted because they'll say, oh, we've got a food crisis and it was because of the pandemic, and they'll make some bullshit stories up. But what they'll do is they'll exert more control over the economy and more control over our freedoms. You won't be free to choose meat, all right? Because they'll say we're in a crisis. How dare you eat the most expensive of meats? No, you should just eat cabbage and lettuces and eat your porridge, you surf. And so that's, and so, you want to try and the only way that you get out of that is to have the tools that they're using to dismantle those. And so ultimately, I think that's going to happen by virtue of the fact that humans want to be free, and they will be forced to go about solving these problems because they'll go, damn it, I can't get enough food for my family at the supermarket and through these rations and everything else. And they'll get together with their neighbors and you'll form new communities and we will solve the problem. But it's not going to come without a lot of pain. Being a lazy guy like me, I'm like, I'd rather drop myself into an environment where that's already built, right? And because the society structure also then doesn't have to go through so much turmoil, because when you go through these periods of turmoil, you're going to have rising crime, you're going to have murders, you're going to have suicides, like you have, and I hate to be the guy talking about these things because it's all bloody depressing, but that's just the reality if you look through historical periods. And so while that is taking place, you've got the World Economic Forum pushing all these narratives where they're saying you shouldn't eat meat, you've got to eat bugs. You shouldn't be driving your car. It emits, too much carbon. In fact, you shouldn't be breeding. I'm not sure you should actually be alive. I mean, maybe population control is better. What about a one-child policy? I mean, these sorts of things are actually, you've read the World Economic Forum stuff. I've read it extensively, that together with the IMF. And if you read through the IMF stuff, that's almost even more frightening. And there are those sorts of things that I've just mentioned get dropped in there, and they get glossed over with these feel-good terminology like sustainability and
equity,
but when you look through what they're actually saying, it's frightening. So
I'll put a link in the description to this full article. We won't go through the whole thing, but I just want to share some highlights. Federal Reserve Chair Jerome Powell believes millions of Americans will return to work and fill some of the 10.4 million open job positions as the cough fades. This is plain wrong, says Christopher Demick from Saxo Bank. Now, he's not the only one. Joseph Wang and many others. I've listened to a few people in the last week that have basically argued you've got people that wanted to retire around the GFC but couldn't. Their retirement accounts were smashed, and so they continued working. And since then, their retirement accounts are very bloated. And so they've decided, we've got enough now, we're retiring. You've then got other people who, in their 50s, maybe pushing 60, who also, their property has risen, their retirement accounts, their stock positions have all skyrocketed. And so they've gone, you know what, we're not coming back. We're taking early retirement. We're going to start to enjoy life. And then you've got the young kids who have been trading call options and meme stocks and crypto, and using not just, as I said, not just the stimmy checks, but using leverage on that, using call options and CFDs, which we've seen, and so they've made huge gains as well. And they're like, well, why would I work for $15, $20, $25 an hour when I'm making $10, $20, $30, $40, $50,000 a month? So yeah, this is and actually, I'm just trying to Jesse Felder. It was Jesse Felder. He was the one who argued. He's the guy that I listened to the other day, I believe, on Macro Voices, and he argued that this is actually going to be inflationary. That because there's less workers that aren't coming back, wages are going to have to rise to try to attract people. That the supply and demand in labour is now in favour of the worker. So anyway, the article goes on and says, employers will therefore have to increase wages for less desirable jobs. These increases could hit the unprecedented double-digit mark. Combine that with all the other inflationary pressures and energy crisis, which we'll come to, and supply chain disruption, and suddenly things spin out of control. In such a scenario, the Federal Reserve will try to react, says Demick, but this is already too late. It has lost credibility. Saxo Bank says US inflation could go above 15% before 2023, so next year. And according to Shadow Stats, we're already at 15% if we want to measure it to how they measured it in 1980. The result will be extreme volatility in US equity and credit markets as the Federal Reserve tries to regain credibility and shove inflation back into the single digits. And at this point, I suspect that we might see the Biden administration implement price controls, but more on that in a second. And the article goes on, the availability and price of many oil-based fertilizers will push up the cost of agricultural produce in 2022, for example. Just as I said at the start of this video, and as Chris Macintosh you saw in that clip, I will be doing a video, one of my 3 videos in the new year, where we're going to go into detail in this. And unfortunately, some of you will be offended with what I have to say. But anyway, we'll have a look at that. The same goes for building materials such as cement, which uses fossil fuels in their manufacturing. So William Nordhaus, a Yale professor and recipient of the 2018 Nobel Prize in Economics, estimates it would take between $100 trillion and $300 trillion in new capital on a global basis to reach net zero emissions by 2050. Inflation could increase this estimate dramatically, forcing governments to delay, pause, or completely abandon all the climate pledges they made in 2021. And this is the thing. This is where governments and central banks are going to pump huge amounts of dollars into this green sector. And this is why I am investing in this sector. And once again, in this video that I do in the new year, I'm going to really go into this in detail. And as I said, it's going to offend some people, but I've got to tell the truth. And I've got to be real with you guys and honest. So, however, I think it's going to fail. And our lifestyles are going to be absolutely destroyed and shattered because this is going to send us back, well, not to the Stone Ages, but it's going to send our way of life and that back a long, long way. So you all know that CPI has risen quite a lot. So here you can see core PCE price index, excluding food and energy, which is what the Fed love to use. Don't know why, because what food and energy is probably the thing that we spend most of our cash on. It's probably the most needed thing in our lives. It kind of, you need it to sustain life. So yeah, you can see that the PCE index rose 5.7% over the last year, which is the highest rate since 1982. Now, a great indicator of CPI, and I got this from Art Berman, is oil prices. The correlation is very tight, and that's because energy is the lifeblood to an economy. Energy security is vital for any modern economy, and it's one reason why I'm bearish long term in the West, as Chris Macintosh talks about, and it's why I'm bullish places like Russia, India, Indonesia, and other emerging economies, and to be honest, even Japan to an extent. Russia's got the best balance sheet in the world. They can pay off their debt with the reserves that they've got. So their foreign debt that they have, the amount of reserves that they hold within central banks and central bank and commercial banks, they can pay that off in no time. And you guys all know, how much debt to GDP they've got. That's under 30%, best out of any major nation. And they've been buying a lot of gold. They're holding more gold now than US Treasuries in reserves. So very bullish. Russia. Now with higher CPI, the whole decarbonisation, ESG, etc., I believe this will prove inflationary over the coming decade. And that's why even without the fiscal and the monetary side of things, I think we are going to have an inflationary decade ahead just because of the whole green movement. It is going to be inflationary, and we are going to have all sorts of problems with building things and producing goods and producing energy, producing fertilizers, producing food. And as I said, I'm going to talk more about that in the video in the first week or so of January. And perhaps some of you will be surprised with what I've got to say in that one. So, it's going to have an impact on our daily lives. So, and that's also why I'm bullish gold, silver, and, several different commodities, which, once again, in this video, I'll break down exactly which commodities I'm bullish on and why, and you'll understand exactly why. For example, nickel and copper. So here's another chart that just shows that. So this is a percentage change from the year ago. A really nice correlation between CPI and the spot crude oil price. And CPI should be exactly where it is according to this chart. Now, I could see, CPI come down, and I'll share that argument in a second. And we could see oil prices come down in the short term. Ultimately, moving forward, probably my prediction is the second half of 2022, we'll start to see higher oil prices. But as the decade goes on, $150, $200 barrel of oil. That's my prediction moving forward in the years ahead. So call me crazy, but that's what I see. So the market believes we'll see 3 rate hikes by the Fed in 2022. I think that might be true. A lot of people say, no, they can't raise. I think they will, just for the politics of everything. They will try and raise. It's just a matter of how much can they raise before we have markets implode. But until then, I believe markets can and likely will continue to go up while the Fed and other central banks continue easing monetary policy, because tapering is still creating new bank reserves and providing markets with liquidity. So just because they're tapering doesn't mean they're not pumping more liquidity into the system. That's what they're doing. So we need to see tapering stopped, and then QT, quantitative tightening, meaning liquidity is sucked out of the system with rates rising. If that happens, and when that happens, I believe we will see the market crash. I think we'll also see short-term yields. They will rise, closing the gap or the curve between short and long-term yields. And as we've seen recently with the euro dollar yield curve invert, well, that predicts recessions, almost 100% of the time. And so I think we'll see this, and that will cause a recession. I believe we will see a recession, and we will see markets crash if that happens. And if that happens, I also see, and so this is probably more second half of 2022, in my opinion, we'll see another power pivot, just like he did in 2018-19 during the taper tantrum, when Powell lifted rates then. Also, at that point, I think if the Fed have to pivot, and inflation is still a big issue, and CPI is still a big issue, then that's going to become a political issue for the Biden administration, especially heading into the midterms. And so I wouldn't be surprised, and this is a bit of a prediction, if all these things kind of play out, I wouldn't be surprised if the Biden administration implements price controls, which Nixon did when he announced them in 1971, when CPI back then was actually lower than it is today. CPI back then was between, 4 and 6% or something. In fact, yeah, and then when he announced that CPI, so the price controls, when Nixon put them in, the actual core CPI actually came down under 3%. And the media, everyone, they said, yep, price controls work, we've got inflation under control. And then as soon as the price controls came off, wow, CPI just shot up to 12.5%. And so I could see that happening. And we can see an immediate reduction in CPI. And you could have, the media just congratulating the Biden administration for taking action against the greedy corporations, and CPI is now under control. However, that's going to come with a lot of short-term, medium-term, and long-term consequences if that happens. It will mean businesses go under. It'll mean less production of goods, and it will mean higher unemployment. And then eventually, you can't keep price controls in place. I mean, otherwise we just become a full communist economy. When that is lifted, then you're going to see CPI like it did in the 70s just absolutely skyrocket from that. So, look, Biden could use price controls and try and show that he's tackling inflation leading into the midterms. And I think, if that was the case, he would have the media and the Keynesian economists like Krugman publicly supporting him. And, I think, a lot of people will believe that because a lot of people don't understand economics. So I could see them using this as a short-term play, which means the Fed could do their pivot on quantitative tightening to keep markets propped up. So that is definitely one of my predictions. But as I said, this will come with all kinds of unforeseen consequences, both in the short, medium, and long term. So also moving on to the stock market then. So with earnings so weak, PEs so high, and interest rates rising, means forward returns on growth will be extremely poor at best, in my opinion. These charts just show the real earnings yield. And have a look at the last time's earning yield. This beats the last 2 times earnings yields were this low. And, what happened there? You guys can see from the chart. So growth stocks have already begun to fall. It's really only a handful of stocks that's pushing the market up, but a lot of stocks already crashed in a big way. Not saying that's a buy, by the way. Now, we are seeing a striking divergence of performance between large and small cap growth stocks, so definitely keep an eye on this. The riskier parts of the market almost always lead the way, so just keep an eye on this, folks. Also today, we're seeing the weakest correlation between small and large cap growth stocks since the peak of the tech bubble. So, keep an eye on this. So in my opinion, value is where it's at in 2022. And no better sector to find value is in the gold and silver miners. And I'm not biased here. I go where I find value, and this is where I find value. And I've shared this chart before. So yeah, we can see on all different metrics that the miners and gold itself, silver, is undervalued. Free cash flow, well, you guys know about that. So very bullish that sector moving into 2022 and beyond. And we haven't even seen the M&A cycle yet. So when that starts, and capital really flows into this sector, it's going to be a fun ride. All right, so with higher interest rates, we will see, we're talking about housing now, with higher interest rates, we will see more housing supply on the market as people overcommitted won't be able to keep up with their repayments, and also the higher CPI or household costs that people are going to endure. And we're already seeing that. Also, banks will tighten, especially if markets begin to fall and that yield curve flattens or becomes inverted. So you're going to see banks, their lending really tighten up. And yeah, we're already seeing supply come onto the market. Personally, I've seen, so there's an area that I'm looking at buying in. So I've been keeping a very close eye on this particular market. And I've seen 3 houses now back on the market for sale, which only sold several months ago, earlier this year. So very interesting times. So you can see from this chart, total auction are back at all-time highs in Sydney, and also clearance rates are now fallen below 50%. And we've just recorded the first house price falls in Sydney since the beginning of last year. Now, Stephen Koukoulas, who's an economist and was a economic advisor for the former federal Labor government and a 20-year property bull, he's now saying that we're going to have a 5 to 10% fall in 2022. So, if he's saying it, he's been a 20-year property bull, like even when everyone's been bearish property, he'll be like, no. So now he's even saying that. So yeah, let's see how this debt bubble plays out moving forward. And turning to gold and silver, if we have a look at this chart, we can see the 2020 and 2021 January open interest, which was 2.9 million ounces and 6.5 million ounces respectively. For 2022, it's 13 million ounces. So clearly someone wants silver in January. And January open interest for silver has never been this high going back to 2006. And the pattern looks quite different too. It's spiking upwards with less than a week to go till first notice. And silver demand looks like it's already increasing, and I'm expecting to see silver really explode up to $30 and then very quickly up into the 40s when that Fed pivot happens or the Biden administration announces price controls. So if we do get rising rates and we see the market tank and we see a liquidity event, then yes, I can see gold and silver getting beaten down. The miners getting beaten down as well. I can see the US dollar appreciating because the dollar denominated debt position around the world, and it's just the safe haven. People will run to it, and so that will actually work out great for me for a play that I've got on, which I've shared with you guys before. But then when that Fed pivot happens and they change things, and we get a big fiscal package, and whether it's some sort of Green New Deal or infrastructure package or whatever it becomes, and we see where the Fed limit in terms of raising rates will be, then we will know what the negative real yields are going to be, because the Fed will reach its ceiling in terms of raising rates, and as I said, probably pivoting and going back into QE. And then if the Biden announces price controls, well, that's when I think we see the real explosion in silver up to $30 and $40 very quickly. Could Basel III have an impact on gold and silver price? Well, we'll soon find out, won't we? We're not too far away from that. Now, my gold target, it's not as sexy as silver for 2022. So my gold target is somewhere between 2,200 and 2,500 by the end of 2022. Perhaps up to $3,000 at the top end of the range there. So, but I am doing a video once again, an early January, where a friend of mine sent me a chart on gold, which absolutely blew my mind, and I'm going to share that. And based on that, based on some of the fundamentals, we could see gold at around $8,000 in 2024, and I'm absolutely open to that. So, I know I've shared some videos with some other people sharing price targets of $8,000 gold by the end of the decade and $10,000 gold by the end of the decade and this and that. However, that hasn't been my target. I've just shared it on this video, and then we discuss it. But based on what I'm seeing and based on this particular chart, absolutely, I am now probably convinced that we will probably see $8,000 gold in 2024. And that's with no financial reset. That's without anything. So stay tuned to that. Now, finally, before we wrap up this video, I did this video, CBDC warning, gold and silver ban, ? I think in 2022, we will see the beginning of all the trials and a slow introduction or implementation of CBDCs. When this happens, it won't be good for freedom and liberty, with a central bank being able to create legal tender. This is where Dr. Lacey Hunt, who's been a 40-year deflationist, says he skips over the inflation stage and goes straight to hyperinflation. If the central bank can create legal tender, he jumps over the inflation and jumps straight into the hyperinflation stage. So, yeah, if that happens at this point, I think it'd be very hard to get your hands on gold and silver, at least at the price around today's levels. So, yeah, these are things that I just think the probabilities are higher than 50% of happening, and therefore you want to own some gold and silver. I want to own gold and silver, not financial advice. All right, so to wrap up my 2022 predictions, let's just have a look at that. So I believe CPI could hit 10%. That's the government numbers. But then if we see price controls, if we do see the Fed continuing raising rates and don't pivot, then we could see CPI fall. We could see CPI fall back into the 4s, maybe into the 3s, but somewhere around that 4 mark. I don't think we're going to see CPI back below 2 again, because we may not be doing the big fiscal packages. The central bank will be doing quantitative tightening, but we have destroyed so much supply, and we are continuing to destroy so much supply and productivity. And so you need to measure the amount of dollars or newly created dollars versus the amount of supply of goods and services. And so you can destroy dollars, but if you destroy supply even faster, you're going to have CPI increases. Okay, so yeah. As I said, price controls, look out for that in 2022. Now, it might not happen. I expected Biden does surprise me occasionally. I thought he would nominate Brainard as Fed chair, and he surprised me going back to Powell. So, I'd definitely rather Powell than Brainard. But anyway. So I think we will likely see 3 interest rate rises followed by a Powell pivot, or at least those interest rates will stop. because I don't think the market can handle where the level of the market is right now. I don't think it can handle 3 rate rises. It definitely can't handle more than that, in my opinion. So I guess we'll wait and see. But I think they will raise rates. So some people say they won't raise rates at all. I think they will. Politically, they're going to have to. They're going to have to show, look, we're doing something about inflation. We're doing something about CPI. So I think they will have to do something. Anyway, we'll see. Stock market crash, value over growth. So if this does happen, then I do see a stock market crash. And look, some people much smarter than me, like Felix Zalou, for talking about a very big stock market crash, not just a 10, 20% correction or bear market. They're talking 30, 40, 50% plus. Of course, you got your Harry Dents and some others that are on the 80% stock market crash. And, or some are actually now saying Gerald Salente thinks that we're going to see the worst stock market crash in history. So that's got to beat the 1929. Would that go down? Was it between 80 and 90, wasn't it? Anyway, so also, I think there's a lot of risk with passive investing now. And Mike Green, who I don't see eye to eye on a lot of things, both economically and I think socially and whatnot. But I listen to him because he's a smart guy, and I like to know where I'm wrong and whatever. But I think he makes some really good points on passive investing, and that's one of the reasons why we're seeing the market go up so much, is because of the capital flows into passive funds or ETFs, and when there's a market crash, then the opposite can and will occur. So I think stock pickers, people who pick stocks, they will start outperforming, and I think value over growth. I think we see the beginning of housing to decline, especially as interest rate rises. I've shared in other videos here in Australia. We've got, what is it, just over 41% of all mortgages are in mortgage stress, meaning measured on a cash flow basis. So cash flow coming in versus cash flow going out. So they got more cash flow going out than they got cash flow coming in. With CPI increases, that's only going to make things worse. And I think the FBAA did a survey, some data, and they said 56% of households couldn't afford a 1% interest rate rise. 56% of mortgagees in Australia couldn't handle a 1% interest rate rise. So I think we see the beginning of the decline, and I think we see bank credit tightening as well. So silver to $30 and then $40, and that's based on the power pivot. And perhaps we see price controls, or perhaps we see a new fiscal package, some sort of infrastructure, Green New Deal type thing. Then I think that's bullish for silver, and of course gold. 2,200 to 2,500 is my base case for gold for 2022. 3,000 at the upper end of that. I think we see the beginning of the CBDC rollout. Unfortunately, I hate the idea of this, but I think it's coming. So what I've been investing in this year, in 2021, is agriculture, copper, nickel, silver, gold, oil, coal, and gas. I've shared in other videos how I made some big returns on Peabody Coal Company, and I've rolled a lot of that investment into other assets, including some oil positions and some gas positions. So, however, I do see that if the market crashes, these things will get will come off the boil. So I could see, like copper, for example. It depends how big the market crash is. I could see copper falling back into the $2 mark, and therefore it's time to load up. So the other things I think in 2022 that I am waiting. So I'm not adding to these positions at the moment, or I'm waiting for this for interest rates to rise and the market to crash, because we will see these commodities initially get smashed down. But these are things that I'm bullish on, probably the second half of 2022 and definitely beyond for the rest of this decade. is lithium, cobalt, uranium, zinc, rare earths, radium, and platinum. And as I said, I'll go into more detail why I'm investing in these commodities in particular in this new video in the new year. So yeah, I'm going to do 3 videos where I break down these predictions. So basically, I'm going to take this video, I'm going to break it down into 3 separate videos where we go into detail about my predictions on gold and silver, to the stock market, and these commodities. So I'm going to share a lot of detail and a lot of facts, which may be hard to take for some folk, and I'm sure that I'm going to offend some people. But as I said, I've got to be true and honest with my opinions and what I see and how I read the economic landscape. And that's, I'm sure you guys, all you expect from me is to be honest with what I see economically and share that with you guys, and share with you guys what I'm doing. I don't give financial advice on this channel, but I be honest with you guys. And doesn't mean I'm always right. Okay, doesn't mean I'm always right. And you know what, guys? You guys can disagree with me, and that's okay. And we can still be friends. So anyway, that's my predictions for 2022. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance Uncut.